Welcome to the PIWORLD interview recorded on the 15th of November 2021. And I'm your host, Tamsin Freeman. And today I'm delighted to be joined by Ian Whittaker, Media and Tech Analyst. Ian, thank you so much for joining us.
Not at all, Tamsin.
So can you tell us a bit about your background?
I worked for 20 years in the City as an equities analyst, sell side. I was covering the media and tech spaces within that time. Then for the past 18 months, I've been doing my own consultancy and advisory business, and that's been advising firms just in terms of the bigger picture, strategic trends and how that impacts their day-to-day businesses. Also as well, looking at general market trends. So for a number of clients, and that's under my firm, Liberty Sky Advisors. I've also as well just recently launched a subscription service that focuses very much on the media and tech space and tries to marry what's happening with companies with the wider picture, both in terms of the macroeconomic and political trends. And then also as well, I've been working on a advisory business with several partners called Bearstone Advisors, which is advising startups and also those firms a little bit more down the line in terms of their options.
So what are the main themes in media and tech today?
So if you look at what's happening in the wider space of media and tech, you've got a number of things which are quite interesting sort of within the arena. Obviously, you have sort of the continued shift of advertising money, which is going online. What's very interesting within that, though, is that some of the so-called analog players, so for example, the broadcasters or indeed the out-of-home players, are now starting to really define their online strategy well, where they're starting to take some of the online advertising money themselves. So you're getting a more complicated picture in there. Yes, you've still got the tech giants very much, which are in there, the Facebooks and the Googles, sort of who dominate the online advertising market. But you now start to see other players who've realized that they also as well need to venture more aggressively within that space as well. Perhaps something as well, which has been quite interesting, it has been on the publishing side. Again, not an area that particularly is seen as that exciting, and usually most people associate it, for example, with newspapers. But you're seeing some very interesting sort of trends coming out of there. Companies such as Wolters Kluwer and RELX have been upgrading guidance. And then also as well, you have a number of attractive businesses there within the classified space. I'd say sort of one of the features that has been perhaps most interesting is that sectors which perhaps going into the pandemic had been seen as structurally challenged and question marks over their longer term future, now actually coming out of the pandemic are performing a lot more strongly than people expected. And the agencies and the broadcasters particularly stand out with that. On the other hand, the Q3 reporting season, what you've seen is some previous stocks where people had been sort of very enamored with the growth rates, and these are stocks such as Facebook and Snap, and now starting to see problems that have been caused by Apple's advertising changes. So there's a real sort of mixture that's going on there at the moment. The final point I would say as well, and this particularly pertains to the online space, is you are starting to see a lot more regulatory and political investigation go into those areas as well. And I think that is a trend that is set to increase over the next couple of years.
So can you talk a little bit more about Apple's privacy policy and what impact that's having on companies that rely on advertising for their revenue?
Well, it's very interesting if you look at what Apple has done, limiting sort of the ability of these companies to track consumers and effectively sort of making consumers opt in rather than having to opt out of tracking. You're starting now to see the impact coming in the financial numbers. So in this past quarter. So previously what you'd had was, particularly on the social media side, companies in Q2 reporting very strong advertising numbers, saying they hadn't seen an impact from Apple's changes yet. You've now started to see that sort of really change in Q3. So companies, for example, such as Snap and Facebook, in terms of the commentary, making it very clear that those changes are having an impact, particularly on the direct response side of things. So this is the immediate sort of call to arms, as it were, to consumers to buy goods. And certainly for those two companies, the impact has been quite significant. Now, you've had others as well say there has been an impact Google, for example, was talking about the impact in terms of YouTube, in terms of their direct response part. So was Twitter. But really, in terms of Apple's changes, really seems to be concentrated on a few particular firms. And one of the things that was clear from the results season is this is not just the end of the changes. There will be more changes coming through from Apple in terms of what they do around privacy. And that's likely to have a continued impact on the ability of these firms to actually able to offer advertisers sort of the ability to really target customers. I think where this goes in the end is, quite frankly, for players such as Facebook and Snap, there's a real fundamental question here. Yes, in terms of measurement, they can probably get a hand on that relatively quickly. The real issue is targeting of customers. And what would expect Apple to do, as I said, is really to continue to roll out these changes. So what happens, of course, is that for these firms, they never really get an opportunity to provide a stable platform in order to say to advertisers, look, we're confident in terms of our targeting messages and we can get this across to consumers. And at some point, what you'd expect is firms just give up and maybe move to other advertising platforms as well. So I think this is a very significant issue as far as Apple goes. Obviously positive for Apple as well, because in terms of its advertising revenues have been going up, and those revenues, of course, are very high margin.
So how does Apple benefit from their change in their policies?
They benefit from increased advertising revenues that come through. There's also as well the question mark over, I guess you could call it, sort of our brand profile that Apple is very much sort of states is very much on the side of the consumer, though obviously when you look at the ability of Apple to track so what people are doing on Apple devices, you'd have to have a large degree of skepticism with whether that's really their true motive here. I think the key thing for Apple is that it fundamentally weakens an opponent, and that would be Facebook. And so what we'd argue here is this has not necessarily been done for Apple's benefit. Yes, advertising revenues are beneficial and it probably helps to contribute to the bottom line, but we're really talking about sort of like a single-digit increase on Apple's operating profits. Yeah, the main bulk of its business still remains sort of very much on the hardware side and also as well services in terms of what it can do from the cut it takes of apps. So I wouldn't say there's a huge amount of benefit to Apple from introducing these changes. But as I said, what it does is weaken and potentially very significantly one of its main rivals. And I think when you look at what's happening in terms of Mark Zuckerberg talking about the metaverse and things being taken to another level now in terms of the development of online, then weakening a potentially very strong competitor can almost be, if not more, advantageous than the financial benefits you gain yourself.
And talking about Meta or Facebook, what do you think of the new branding? And do you think that's an effect of the whistleblowing, or do you think that's a strategic move that's a good move?
I think it's a mixture of both on the branding. It's been coming for a while. Obviously, in terms of the Facebook brand, it has attracted a lot of attention, quite negative attention from regulators, politicians, also as well consumers. It's clear from the polls that consumers don't necessarily trust Facebook. So it was clear that there was a rebranding effort that was coming through. Having said that, this is also as well a very major strategic shift that Facebook is doing. And it is clear now that the metaverse very much will be their number one priority over the next couple of years. It's worth looking at the numbers for what Facebook is doing. Facebook has said it will spend $10 billion in 2021 on the metaverse and related activities, and that will increase each year for the next several years. So you're probably looking at well over $60 billion cumulative total in terms of spend on the metaverse. Now, that obviously is a massive amount. It's a very long-term effect. Facebook has said it doesn't expect a return to be generated on its investment until the latter part of this decade. Obviously, if you're spending that amount of money as well, what you are very likely to see are other players come into the market. And this is very much of and this works on two ways. One is direct competitors. So you've already had the likes of Microsoft talk about this, but also as well, so the old adage of if you have a gold rush, it's often better to sell the pickaxes rather than get involved in searching for the gold itself. So this amount of money that has been pumped in will naturally attract support firms who will look to benefit from the increased investment that's coming through in this area. So certainly from Mark Zuckerberg's standpoint, when he looks at the metaverse, he sees it as a very much long-term project. The talk is always that there is a book that's called Ready Player One that deals very much with this subject, and apparently that's a favourite book of his. And when you read that book, you can see sort of where some of the ideas of the metaverse are very much coming from. There are some very interesting implications, of course, here, not just from a tech standpoint, but also as well from a wider societal standpoint. If people are spending a lot more time in the digital world, what does it mean for what they're doing in the physical world? Yeah, if you already look, for example, at what's happening in China in terms of their sort of government's reaction to the concept of the metaverse, it seems very much as though they're realizing that this could be a potential sort of issue, certainly when it comes to sort of people spending too much time in a digital environment. You've seen this in Japan, funnily enough, with young adults. Yeah, this very much sort of the retreat that goes sort of back to the home, and young adults spending a lot more time online, sort of immersed in a virtual world. The final point I would say as well is that certainly with the metaverse, we've been down a lot of this before. Yeah, the games industry, for example, you think about avatars, you think about virtual worlds, if you think about sort of virtual economies, that the games platforms, companies like Activision Blizzard, try to generate extra revenues from, sort of from selling digital items. So it's not as though Facebook is going, or Meta as it's now called, is going anywhere that is particularly new. I think the difference is the scale of its ambitions, sort of taking it from a limited area in terms of games, really really across sort of the whole fundamentals of society. And as I said, that's going to have a number of major issues moving forwards.
So do you feel it's now is the time to invest in Facebook if you haven't already done so?
I think if you look at Facebook, what would say is that there are a number of fundamental questions surrounding it. It's taking a big bet on the metaverse. So you go back to some of those numbers before in terms of the cumulative amount of spend. There's also as well an interesting question whether at some point the legacy Facebook business actually gets divested from Meta as well, because it has got a toxic brand, growth is slowing, there's a question mark over whether young audiences are very much tuning into Facebook, and this was indeed one of Mark Zuckerberg's stated priorities when he's looking at the future of Facebook over the next couple of years as well. But, at the moment, they are still making, and again, the metaverse concept for Facebook, very big, but it's likely to be very loss-making for a number of years. They still very much rely on their core advertising revenues. And as said before, certainly in terms of Q3, the message that came across from Facebook and from their peers was that they are now starting to see a significant impact in terms of their advertising revenues and being able to target based on Apple's changes. Now, if that continues or indeed ramps up, then there are going to be question marks over the growth of Facebook's ad revenues moving forward.
Why do you think the Trade Desk and Tremor were unaffected by Apple's privacy changes?
Well, I think if you look at the privacy changes for now, they're very much targeted in the direct response area as well. If you look at the rest of the online advertising environment, it's actually been very strong. So if you take what Google Alphabet was talking about in terms of the growth of search revenues, also as well look at YouTube revenues as well, very strong growth, mid-40s growth. In Q3, you look at Twitter, beat expectations as well. You look at the whole of the online advertising environment, still remains very strong. The impact, I would argue that in terms of Apple's policies, in terms of the privacy changes, have almost been deliberately targeted to impact Facebook the most. So what you may argue, particularly as Facebook deals with most of its online traffic direct, it comes from SMEs rather than necessarily going through the likes of the Trade Desk or through sort of the middlemen and so forth. But realistically, those players yet wouldn't get impacted. I think for the ad tech space, the bigger question is what happens over the next 2 years. Yeah, it's not just Apple changes, it's what Google's doing as well. What happens when cookies are phased out, the impact of that moving forwards as well. And also as well, what you've got here is that you've got many more advertisers who are now treating data as a resource to be exploited. And this doesn't just go on the advertiser side in terms of your Procter & Gamble's and Unilevers, but particularly when you look at the likes of Walmart and Target in the States, are becoming a lot more aggressive in how they handle data and how they see this as an opportunity for themselves moving forwards. So what that is likely to lead to it is very much publishers, advertisers. There's likely to be sort of over the next couple of years, I think, very much of a hoarding of data. And there'll be a lot more selective in terms of who they will do deals with. So I think for the ad tech space, sort of it's probably too soon in terms of Apple's privacy changes, in terms of the impact. Given another 18, 24 months, we could be seeing some quite significant changes. And one of the things that I would expect is I would expect further consolidation to come through in the space.
So what other media and tech stocks do you think look interesting now and why?
If I was to look at sort of one particular area that I think is interesting now, the area that I would home in on are stocks that have been unloved, but actually seem to be bouncing back more strongly than expected during the recovery. So I mentioned before about agencies and broadcasters. If you take the likes of the WPP, even though it's had a recent rally post its results, it is still trading on low teens PE multiple, which at this stage in the recovery, and given the fact you've had upgrades coming through, you would have expected more to be in the high teens category, maybe even the low 20s category as well. ITV is another interesting stock as well, and indeed broadcasters generally. But if you take ITV, it's still trading at a relatively low multiple, probably around 10 times earnings. And yet, if you look at the advertising growth that has come through, it's been a lot stronger than expected. Now, the fundamental question for these types of stocks is whether this is a dead cat bounce, whether essentially, yes, the recovery has been stronger, but essentially they revert their trend line afterwards, or whether this is something more sustained, and whether during the pandemic that what you've seen is that advertisers have come to really appreciate their qualities more than they did pre-pandemic. And there is an argument for that. There's an argument to say that certainly in terms of TV, it's gaining more ground in video on demand, so capturing those online revenues, and also as well greater realization that linear TV still plays a role in people's lives. And in terms of the agencies, I think that many advertisers, sort of when they looked at the situation, they realized that the whole idea they could perhaps disintermediate the agencies and take a lot of the business in-house, that really wasn't going to work. So, there's a very interesting question with those stocks. Relatively low multiples, you would argue certainly on a 5-year view have been left behind. The question now is, the fundamental question is, structurally, are those stocks sort of now on a recovery path, or do we go back to the pre-pandemic trends? And that, I think, is something that will become clear over the next 12 months. Obviously, then, if you look at sort of another bucket of stocks that you could talk about, M&A opportunities are always sort of a particular area. What I would say here is that I would expect a lot of consolidation to go on, sort of particularly, I think, in the tech space, sort of over the next 12 to 18 months. Money's likely to remain extremely cheap. If we look at the reaction in terms of government or central banks on interest rates, it's very clear from what the Fed's saying and the Bank of England that, yes, even if rates do edge up, they're very unlikely to sort of go significantly higher anytime soon. And so what that means is that you will get sort of many firms will have access to cheap capital in order to fund deals. And also as well, in terms of valuations will probably look more attractive than they would have done in a higher interest rate environment. I think also as well, look particularly in the space of I would say, online classifieds, and particularly I think moving forwards, areas such as grocery deliveries, there has to be some consolidation that's coming through within that space at the moment, and maybe weaker players that get caught up as well. Finally, what I would say is that you're looking for stocks which essentially, and this is what I've always said, fundamentally are high quality. These are stocks that have got dominant positions within their market, sort of high growth areas, particularly sort of structurally, sort of the picture looks quite bright as well. And I've always liked the classified space, for example, in terms of online property classifieds or automotive classifieds. Again, they tend to be quite highly rated because they're high growth at the top line, but also as well high margins. But again, if you're looking for that solid growth moving forwards, they're also quite an attractive area to look at.
So specifically there, you'd be talking about Rightmove and Auto Trader.
I think from longer term shareholdings, I mean, what we'd say is, of course, everyone has their own different investment environment, sort of timeline in terms of how they look at things. And what we'd say is that, people have to sort of marry that with the stocks that they pick. For me personally, I think the most interesting ones at the moment are in the first category, sort of what talked about stocks that have been very much seen as left behind when it comes to the structural sort of trends pre-pandemic, but obviously sort of have seen a sharper bounce back sort of moving forwards. But as I always say, sort of this is not investment advice. This is me very much looking at the fundamentals on this and saying which particular areas might be interesting to look at.
So you mentioned ITV, which also has been speculated would be ripe for acquisition as well, but that could equally be threatened by video on demand and other subscription services. They have their own video on demand, but I'm thinking more of the sort of Disney and Netflix. What's your view on that for ITV and the other broadcasters?
Well, I think when it comes to subscription video on demand services, there's a question of how much more the market can grow. So if you look at Netflix results, yes, subscriber numbers were better than expected, but a lot of that growth is coming, for example, from Asia, which also as well tends to be a low ARPU market. If you take, for example, Disney disappointed on their Disney Plus subscribers. So, there's a real fundamental question here of how much more that bandwagon has got to go. I think also as well, the other thing to bear in mind with these subscription services is they tend to have a limited amount of viewing time. Netflix doesn't release that much data on how much viewing there is, but certainly in the States, which bear in mind is probably a more advanced subscription video on demand market than maybe in Europe. When you look at numbers, 2/3 of video watching is still through the traditional platforms, whether that be broadcasting, cable, or so forth. Streaming services, yes, they have around 25% of viewing, but when that is split up amongst multiple players on here, I think for the broadcasters in general, including ITV, what they've realized, because of the classification where video on demand is treated as online revenues, that's an area that they can offer a brand safe product to a mass market audience, and that is appealing to advertisers. So I think sort of moving forwards, you see the first 9 months of the year, ITV's VOD revenues were up 54%. I think that growth will continue, that strong growth will continue, but I don't think there's a huge threat that's coming through necessarily to that growth from subscription video on demand. The wider argument, of course, is that sort of subscription video on demand viewing is impacting linear TV. The point I would make about that is that, yes, linear TV still continues its trends downwards, but where the viewing declines tend to be very much concentrated on the smaller channels. You look at the bigger channels are actually doing sort of much better than the market average. And so consequently, the ability of TV still to offer mass market audience remains.
And what about cinema? Is it affecting cinema?
Well, it's an interesting question if you look at what's happening with the cinema space, because go back around 12 months ago, many people were suggesting the cinema space was dead, that effectively it would be structurally sort of ravaged by the fact that the subscription services, particularly likes of Disney, Warner, etc., what they would do is move their content from going in theatrical releases, very much sort of move it towards their own streaming services. And so what you would get is simultaneous releases, both on streaming and on theatrical releases. And therefore the view was that essentially theatrical, because it no longer had exclusive window, sort of wouldn't survive longer term. And that sort of, as a side point as well, many of the companies that owned cinemas also were highly levered. What you've seen now, I think, is a lot more of a positive tone on cinema. There is a realization that in terms of for cinema, it does reach an audience that streaming services don't, that people do want to watch movies on a big screen. And you start to see companies now, such as Disney, reintroduce the exclusive window for cinemas as well. So my feeling is what we'll find is that moving out of the pandemic, cinemas will come back. And I think the medium to longer term future for cinemas actually looks reasonably healthy. There's a question mark, of course, about the companies sort of that own the theatres in terms of their debt levels, and some of them have already restructured during the pandemic, and that leaves them in a better position. But I think as a medium, I think it will still remain attractive to consumers.
Thank you. And I know Pearson reported in the period. How have they handled the transition to digital, and how are they doing at the moment?
Well, Pearson's an interesting one. If you look at the past 7 to 8 years, it's been punctuated by profit warnings. There's been a continual downgrade of estimates coming through. You've had sort of the new CEO come in, Andy Bird, who very much sort of introduced the strategy of going direct to the consumer, and Pearson has launched its Pearson Plus product. I think, though, there are significant questions, and you can see this in reaction to the Q3 trading update, where the shares fell over 12% on the day. What you're finding there is that essentially for Pearson is still very much linked in with the performance of the US higher education market. And that is very much determinant on enrollment trends that are coming through, also as well, so students buying less or paying less for their academic materials. And there's a question mark, I think, for the Pearson Plus app, whether it's also too late as well. Its main rival, Cengage, sort of had introduced an all-you-can-eat offer sort of nearly 3 years ago now into the market. So it's had very much of a head start on Pearson Plus. My own view on Pearson is that I think where the bigger opportunity lies is very much post-education, very much in terms of the workforce, because we're going through times where there needs to be constant reskilling, constant changing of jobs, and needing to learn sort of new abilities. And I think that's really where the big market lies. I think fundamentally the issue with folks on trying to fix their problems in the US higher education market is there is a risk of fighting the last war rather than looking forward to the next one. So I think with Pearson, you would argue, yes, that they have introduced a number of digital initiatives. Some of them have gone very well. They're obviously very much in a state of transition. Some of their businesses continue to grow very nicely. I would still, though, have this question mark of, if you are going D2C, is it better to go for the student or is it better to go for the worker? And my view would be better to go for the latter.
So for now, it's one to watch rather than to buy.
I think you see how it goes. And as I said, very much over the past trading update, certainly investors reacted very badly to the news that they reported.
Ian, thank you very much indeed. Can you tell our listeners where they can find out more about you and your musings?
Sure. So I have started a subscription site. It is very much focused on sort of media tech and the wider questions sort of very much around that. That is at www.ianwhitakermedia.com. So they can find me there. So I mentioned it as well. So they can find me on LinkedIn, which is also a very good tool to find me on as well. So those are probably the two areas I would direct people to.
Tremendous. Thank you very much. And is the offering more for institutions or is it for anyone?
I would say it's probably more targeted at institutions and certainly companies within the space. The one thing that it is sort of more focused on, as I said, is looking very much at the bigger picture and what that means for firms. So what I try to do is my financial experience with also as well sort of my knowledge of the media and tech sectors, and try and bring that all together. Also as well, sort of just so in terms of where people can find me, I also as well do write a number of columns as well. So I write for City AM on a monthly basis, and also as well, which is more specialised trade publications, Campaign and VideoWeek. But probably if people want to find out more about my thinkings, I would direct them to the subscription service.
Tremendous. Thank you very much indeed.
No problem, Tanza.
And to all our listeners, please comment on our content on the various social media platforms. This helps us get the very best speakers. And to subscribe to receive a notification of a new video as it's published and no spam, go to piworld.co.uk. At the top on the side, subscribe. Many thanks for listening and stay well.